Hello, everyone. Thank you very much for joining today's webinar, which is being recorded on the 27th of March. I'm joined by my fellow director, Clint O'Donoghue, who's head of our business development, and a few other people from the Alpha Wealth team. And I'm delighted to talk to you for the next 25 on this concept of financial independence and really giving you some really broad tips and ideas about how you can successfully retire at the earliest stage possible. Please do feel free to pop any questions that you might have into the chat function. Cleaner's going to be managing that. And we do want to make this as kind of interactive as possible. We have had some questions over the last few weeks that we will address during the course of this and towards the end. Just to mention, it's quite a bit to go through, but anyone who's not familiar with Alpha Wealth, we're a progressive financial services company with offices in Cork and a presence in Dublin. We have 12 expert financial individuals giving guidance to individuals like yourself. Just in terms of today, the main things that I want to get across are what is FIRE, this financial independence retire early concept, and why is it relevant to you? Some practical actions that you can take that will benefit you now and in the future, and then showing you some specific tips, some tax advice and investment strategies. So just to start with, what is FIRE? This is a movement that emanated in the States back in the early 90s. And whilst in its pure form may seem quite extreme, it was talking about the concept of retiring, in some cases, well before 50, don't mind 60 years of age. There's still quite, in my opinion, some good learnings. And whilst I think it's unrealistic for most people on this call to retire in their 40s, the main things that I would take from this is what is financial independence? And the best definition that I found is that it's essentially achieving three things. One is being debt free. The second is covering all future expenses with accumulated funds. And the third is having this passive income that gives you a lifestyle that supports your income requirements at a certain percentage withdrawal rate, typically 5% used. And if you work backwards, there's this concept of your number. So if what that means is, how much money do you need to give yourself that income that you require? Now, obviously that can vary depending on the individual, but an example is, let's say if you want 50,000 a year, broadly, an asset base, which could be made up of property, pensions, and other investments worth about €1 million, a 5% drawdown on that would be your 50,000. The other concept of FIRE is around this getting to that point as early as possible. And I'm going to explain that to you as we go through this. And again, for anyone who's just joined the call, please feel free to pop any questions into the chat function. I've just popped up some articles that we have published and had published over the last year and a half around this movement. And it has taken, I suppose, a lot of presence, especially with this advent of, people who are looking to try and get rich quick and so on. And whilst I'm not an advocate of these so-called speculative or get rich quick schemes, as I said earlier, there are definitely some learnings that we can all take from that. If you look into FIRE, you will find out there's a little bit more to the fact that there are different types of this kind of passive income requirement. For example, there's something called coast FIRE, where you basically save aggressively in your early years, maybe through a high income paid, stressful type job, to then relax in your kind of 40s and 50s, still working, and hence the coast element. Or those that, again, called barista FIRE, where you may have a relatively low requirement for income and you're effectively just kind of giving yourself enough of an ability to be able to take that sort of passive type environment. But again, we're not going to get into the kind of the weeds of this. I just want to explain that there are different variations. It's not just a one fits all. Now, in terms of like, how do you reach your number? And I suppose what we talk about then is this first of three things that I said is becoming debt free. So the way to become debt free, first and foremost, is trying to avoid all unnecessary loans. I come across a lot of people who I would regard as fairly wealthy or successful, who have very high incomes, that still take out car loans, even though they don't necessarily need to. And it's probably a habit that we've all got very used to. It's not one that I like. I have a big issue with people who borrow money unnecessarily. And I talk about then the ability to repay back loans through what I call the snowball principle. This is starting on typically the smallest loan first, aggressively paying it off, moving on to the next one, hence the snowball. Now, if you're wondering why am I so against loans like car loans, and I appreciate many people on this call may have a short-term loan or a credit card debt or indeed a car loan. The best example I can give you is that if you say borrow 20,000 euros over 5 years, and using Avant Money as an example, I did this on their website yesterday. You can typically borrow money at 6.8%, which will cost you about 392 euros a month and around 3,500 euros of interest. And you might think that that's not particularly expensive, and maybe that's what's wrong with that. The major issue I have is not just the fact that the interest rate is so high. 6.8% is a very attractive rate in any savings account, but also the 392 euros a month is an opportunity that you are foregoing in something else. For example, if you were to put that same 392 euros a month into your pension scheme, that would actually gross up, if you're a high rate taxpayer, typically earning over 44,000 a year, of about 653 euros a month. And if that was to grow over those same 5 years at the same growth rate, you could have the equivalent of 50,000 euros. Hence why it's such a massive thing for people to recognize that if you have any direct debits going out of your account, you need to look at whether or not they're absolutely necessary, because obviously this is the whole thing about making your
Well,
money
Nick,
work
before you move on
as
from
hard as
that
possible.
slide, I've got one or two questions for you. You talk about, reaching that number, and the example you gave on the earlier slide was of 50K. Is that 50K gross, or is it 50K after tax? And typically, what age would that be to reach that kind of 50K for 1 million with 5% kind of withdrawal example?
So that's really helpful. And I was going to talk about it later on. It's a very good question, but the answer slightly varies, obviously. Like, for example, that 50,000, it could be gross, it could be net. That depends on the person as an individual. So if you have, I suppose, a desire to have a fairly comfortable lifestyle in retirement that does require you to have a higher income, then yes, you may need that as a net return, or it may even be higher. Or if you have a fairly kind of moderate, I suppose, expectation and don't particularly like traveling much, then maybe less than even 50,000 gross would satisfy your needs. It may depend on if you're in a relationship with someone that may also have an income, or if you have to support them. So the answer can vary as to when. This is the whole concept of getting to that point as soon as possible. And one thing that we do, and I'm going to show you this in a moment, for every person that we meet in Alpha Wealth through David Looney, my colleague, senior financial planner, and myself, is we talk about, getting to that number, showing you a projection and revising that yearly, because it is really important to keep coming back to this, guys, making sure that you're reevaluating your plans and adjusting your situation.
Sorry, Nick, just before you move on, you've mentioned as well, start by becoming debt-free on this. Does this include your mortgage as a debt?
It does, but the mortgage is the one that I have deliberately left off this slide. I will get to it in a moment, but that's the only loan that I'm comfortable with. It's almost impossible to buy a property in most cases without taking out a mortgage. The mortgage being the cheapest form of debt you'll get. It's the other loans that I have an issue with. So the point being is that get rid of any of those non-mortgage loans and then set out a strategy as to how you can repay back your mortgage. But you need to quantify that. And I'm not saying to be obsessive about paying back a mortgage. And I will address that as we go through this. But one of the key principles of FIRE is this concept of compound interest. And Einstein coined it as one of the most powerful forces in the universe. And this is really about the return of your money over time and the growth that you'll experience. And the best graphic I can show you is that I often meet people who have money sitting in accounts, which could be earning close to zero if they leave it in the credit union or in a bank account that isn't a fixed term account at any reasonable interest rate. And they wonder why it's so important that they get a more positive return from their money. So, for example, if you had 10,000 euros over 5 years, growing at 4% a year, which is very achievable in certain accounts that we can talk to you about, that will give you about 12,166 euros. However, if that same 10,000 is only growing at 1% a year, you would only have about 10,500 odd at the end of that same term. That's a difference of 15%. However, if you extrapolate that out over a longer term, over 10 years, where you would expect a slightly higher growth rate because of that, a figure of say 50,000 would generate 81,000 in comparison to 55,000, again growing at 1%. That's a massive variation. And that in one slide is this concept of compounding and why it's so important when it comes to your medium to long-term financial goals. Buying a house in 5 years, retiring early in 10, 15, 20 years. You really need to play on this, guys. Getting your fees down to minimum and making sure that you're in the best types of accounts to give you the best growth. And the growth rates that I've used here are typically quite low for pension funds, but would be appropriate for saving schemes. For those of you that are looking to save monthly, let's say, for example, the child allowance for your child, if you start saving from the time they're born for 18 years, for example, it doesn't have to be that period, at a 5% return, that would give you about 50,000 euros. But if you put that money into, say, the post office, which gives you currently about 1% interest, the same amount would only give you around 33,000. That's a 50% difference over that period. For those of you that maybe are saving in for 5 years for a new car or for a deposit for a house, again, you can see on the right-hand side of the slide the reason why getting a better return on your money is so important. And this really is, I suppose, the cornerstone of what the concept of FIRE is.
So Nick, just before you move on from that slide, just a few questions in around where can you get 5% take when you take dirt and CAT out of it?
So dirt tax is only applicable to deposit accounts. The 5% that I referred to here is going to be an account that I'm going to discuss later. We put together an account to help people get access to these. The life insurance companies offer them, and there's a variety out there, the likes of the Zurichs, Irish Lives, Avivas of this world. But the key thing to watch out for, guys, is that some people either set these accounts up paying way over the odds for them. I think it's really important to understand fees are a bigger order to the return that you can generate. If you're paying, let's say, the 140 euros a month into an account that can generate 5% a year, but you're starting off with a 2% entry fee and let's say a 1.5% annual management fee, you're broadly going nowhere. The key thing to recognize is that return that is absolutely achievable. And I'm doing it myself, and I'm going to show you my own savings account through this will definitely give you those types of returns. Just moving on, because I will address that more in a moment, but I often get asked, should you pay off your mortgage or should you invest? For those people that have maybe accumulated money in the bank, I'm not sure what to do with it. And the starting point that I would say is if you've got a mortgage, let's say at 3%, and nobody on this call should be paying more than 3%, in my opinion, on their mortgage interest rate. And if you are, you should seek advice. Interest rates, as we know, have fallen 6 times over the last 18 months or so. And the banks typically are offering rates in and around that. And even if you're on a fixed rate of over 3%, you should look to renegotiate it with your current bank. But the equivalent, let's say, in an investment would have to be at least 6% in order for it to make sense over redeeming your mortgage. And that might surprise some people. You might say, well, why do you need 6% if my mortgage interest rate is only going to save me 3%? The reason is that you do pay management charges on these investment or savings accounts. Typically in Alpha Wealth, we offer around 1%, no entry fees and no exit fees typically. A lot of people may be paying a lot more than that. But once you deduct that, you're down to 5%. And once you pay tax on your gain, and you will always pay tax on any gains outside of your pension, that will give you the equivalent of 3%. But the thing is, with these investments, they are not risk-free. They can be very low risk, but they're not completely free of risk.
So Nick,
Now that does.
would you recommend clearing a checker mortgage worth 70k or saving the 70k to a long-term savings account?
It would depend, and I'm going to get onto this, but A tracker mortgage, as much as people might feel it's attractive, it depends on what is your interest over the base ECB rate. Some tracker mortgages were offered at 0.5 to 0.75%, and some trackers at north of 1%. But if you have the ability to pay down a tracker rate mortgage, then yes, part of your solution should be to consider the balance of where do you apply your money. And it isn't just a once off solution, so it may be dependent on what other financial objectives you have. Are you looking to trade in your car in 2 years? Because if you are, it wouldn't be sensible for you to try and use all of your money now and then go off and borrow money at 6, 7, 8% in 2 years' time when you don't have the monies available. So you need to kind of find the balance. But just to move into that, the main thing next is once you look at what debt you have, is look at compartmentalizing the money that you receive every month from your income and any money that you have currently into these three different pots. And I refer to the short, medium, and long term. Now I'm going to talk about the medium term first. This is the 3 years to that age of financial independence. And for a lot of people that we work with in Alpha Wealth, we look at age 60, if not sooner. Now, again, I appreciate that that may not always apply to everybody, but we show you how you can achieve that. And it's not maybe as taxing as you may think. Now, in relation to managing certain aspects, for example, a lot of people that we meet have too much exposure to individual shares, mostly because they get shares from the company they work with, either through part of their remuneration or they buy them. And I am an advocate for buying shares in the company. You typically get them a discount, but not holding too many at all. And most people, unfortunately, either because they don't want to pay capital gains tax or they don't recognize the fact that there are better, more tax efficient alternatives. And on the screen there, I've shown examples of like Pfizer, whose share prices have actually fallen in an environment that most company shares have gone up significantly in the last 5 years. Again, no disrespect to Pfizer, but that's been a poor, performance, even in an environment where things have gone very, very well. The alternative, let's say, for anyone who works in PepsiCo, is that their share price has done extremely well. But neither of them are the solution. Neither if you held shares in Lilly, which has done extremely well, Apple, Microsoft, or whoever. The reason being is that it goes down to diversification. The fund I've popped up on the screen there called Global 5-Star 5 is a really good suggestion as to have the diversification actively managed that over the last 5 to 10 years has given a more consistent performance of about 11 to 15% per annum. And if anyone doesn't believe me, the Magnificent Seven, which makes up about 30% of the S&P 500, believe it or not, just those 7 companies makes up 30% of so-called 500 companies. They're typically all negative since the start of the year. And whilst they continually tell people to sell shares in these companies that they work with, because they've got too much exposure, they're on this carousel that can stop. And unfortunately, it did about a month ago. And I'm not suggesting for 1 second that those shares cannot recover. The point being is that it's just too much exposure. And you're going to suffer periods that we've witnessed in the last month in comparison to other stocks that haven't. For example, European, particularly defense stocks, have done extremely well over the same period, as had other instruments like gold. So having too much money in these companies is not a good idea.
So Nick, on that, a question has come in. As a doctor, I have a GMS pension, make yearly AVCs to Prime 5 and Goodbody dividend income funds. I max out my AVCs every year and also have invested in the S&P monthly with the remaining. Am I too exposed to one particular market location? Should I consider diversification to get to financial independence? I'm 42 years old.
I do appreciate your question, and thank you for being so specific. Yes, you've got too much exposure to the S&P. As you can see on the screen there, the reason why I'm not a massive advocate for the S&P 500 is that there's too much company concentration, as I've just explained, the 1/3 in Mag 7, too much country concentration, all in the US. I've explained the European market has vastly outstripped it this year. The sectorial concentration, obviously mostly tech, which doesn't really sit well with us at the moment. The fact is that you may be paying more tax than you realize, typically at 41%, and it is quite aggressive and risky. And whilst at 42, you may be accepting of risk, you really would want to have 5 to 10 years. And whilst I'm not saying that you shouldn't have any exposure to the S&P 500, you generally get most of it through your pension investments, is that you may not have those 5 to 10 years necessarily, because there may be other options that may suit you better that are more tax efficient. But you would need more advice in relation to the pension funds that you manage. I'm not a massive fan of New Ireland investment managers. Prime performance respectfully over certain other companies, and the Goodbody funds, whilst they would be generally good performing, are probably a little bit too sectorial biased in my view. Just on the whole point of market volatility, the slide that I've just shown you there, markets performed well up until the 29th of February. And then when Trump started making these tariff announcements, they fell quite drastically. The S&P 500, as a case in point, by about 8% since that date. Now, in the last few weeks, it's slightly recovered. However, Trump made some noise last night. Again, this has been recorded on 27th of March, around basically tariffs on pharma companies, particularly coming into the US, primarily kind of Irish-based ones, unfortunately. And we saw a big fall off on some of the pharma companies. This is all going back to what I said earlier about not having enough diversification in different asset classes. But if you take a longer term view of the S&P, so the 1 year view, the 5 and 30-year view, you would have done very well. So we can't take too much heed to the short term movement, but that doesn't mean that we should overexpose ourselves either. And the key point is you've got to redress where you have your exposure. Is it suitable? And what other alternatives are out there? I'm often challenged by people that want to buy investment property, and I talk about the pros and cons. Investment property has done very well, obviously, as we've all seen from the increase in house prices. And the fact is that we're in a housing crisis. The rental income has obviously done very well for people as well. But then you have to look at the fact that it's quite an illiquid investment. It's quite expensive at the moment, in my opinion. That's where I don't see enough value for people. Then there's the risks of, government change, tenants not paying rents, the government intervention around things like rent caps. You may get, the PTRB board coming in and making you fix up the property and so on. There's a whole plethora of different things. So for me, it's around just recognizing where is your exposure and can it be mitigated? And as I mentioned earlier, there are other solutions. So anyone who's wondering about getting 4, 5, 6% a year in these types of medium-term accounts, 3 to 5 years plus, typically, we devised a solution for our clients called the Alpha Savings and Investment Club, where we use the best fund managers in Ireland to get the best returns. This is an example of one of them we're using Zurich for, in funds called Prisma 4 and 5. These would be two of the best performing in the medium, which is Prisma 4 for 3 to 5 years, and in the medium high, which is Prisma 5 in 5+ years. And if you can see at the bottom of the screen there, Prisma 4 averaging somewhere between 6 and 8% a year, and Prisma 5 averaging between 10 and 12% per year. Now, without getting into that, there are other alternatives as well, like gold, for example, which is a fund offering within Zurich. So you can get exposure to other asset classes. And this is my savings
Sorry, Nick,
plan with
just
Zurich.
before you move on and explain your savings plan, can I there's been one or two questions. So can somebody just buy the Magnificent Seven and S&P or Vanguard themselves without any Zurich fees? Or somebody else has said, currently using DeGiro to buy shares. Where is the benefit in using Zurich, New Ireland, etc.? For context, my DeGiro portfolio is at an 80% gain, while my pension is only at 30% gain over the same period, 5 years.
Well, your pension fund is underperformed because it should have performed much better than 30%, as I've illustrated to you on earlier slides. Whilst your DeGiro account has obviously performed very well, respectfully, the last 5 years have been very positive for investment markets, as I've explained, but I'm fairly sure that you've probably suffered over the last month, and I'm not convinced that you're necessarily going to do as well, certainly for the next 5 years. The benefit of Zurich is, firstly, the fact is that they're going to give you more diversification. And with all due respect to anybody that's investing themselves, as I've suggested, you're only going to typically expose yourself to shares. And it's great when things are going well, not so good when things aren't. And we know Trump is very volatile, and I'm not so totally convinced that, being invested in a pure equity fund is the best way forward, as described by the fund in gold, for example, which has actually outperformed equities over the last year or two. As well as that, it's giving you that, increased exposure to other asset classes. But to answer the point, why Zurich and why the other life companies? The fact is that they're actively managed. So they would move your exposure. As you can see here, they talk about their positioning in relation to moving away from, say, US into Europe, going into more defensive type stocks, taking account of other asset classes like gold and oil. Pensions have to be done through an investment manager. So you can't invest in the zero in your pension per se, typically. And for most of us, it makes sense for us to use the life companies because they do it for us. They discharge the tax on our behalf, and the fees can be quite low. As I mentioned earlier, in Alpha Wealth, we typically charge a 1% management fee, no other fees or charges, no entry fee, no exit fee. I would prefer, and I do prefer, as I've explained, because I get Zurich to manage my money for me, that I have exposure to the gold fund, Prisma 4, Prisma 5, where I'm saving 279 euros a month. And over the last 3 years or so, I've saved 10,700 euros and I've made 12,771. And I have not done one thing in relation to this account. I haven't changed the funds. I haven't reacted to the last month. And I have the best of confidence that Zurich are going to make those decisions on my behalf. And I've benefited hugely from that. The other thing to get onto is, and again, I'm conscious of time, and thank you for the questions. Short term, if anyone has financial objectives, which we all do for less than 3 years, it's important to recognize you should not be in DEGIRO and you should not be in Zurich. We cannot take risk for anything that we want to spend money on in the next 3 years. This could be a holiday we want to go on later in the year, Christmas, a car that we want to change next year. And yet a lot of us have money sitting around in accounts, possibly in poor investments, possibly in the bank, AIB, Bank of Ireland, whomever, credit union, pays 0% dividends, but people keep putting money into them even though they're telling you that they don't want it. Whereas you can get returns of typically 2.5% to 3%, taking advantage of instant access accounts, namely for anyone who has a lump sum, let's say 5 grand in the bank that they want to spend later this year. In my opinion, they should take advantage of accounts such as Raisin, who, as you can see there on the screen, will offer 2.47% with a Swedish AAA rated bank under a deposit guarantee scheme, which is instantly available. However, you can also use then term deposits like an account with another Swedish bank, again under the deposit guarantee scheme, one of the safest banks in the world, paying 2.6% fixed for 3 months, and so on and so forth. However, for those of you that want to save monthly, there are also alternatives in AIB Bank of Ireland, paying 3% as long as you stick to the terms and conditions. And for everyone on this call, they should be putting some monies, even if it's just 10 euros a month, into that type of account. Going back to this concept of FIRE and how can you retire successfully? I say this to everybody. If you have between 6 to 800,000 accumulated in a pension fund or made up of a pension fund or an investment property, in my opinion, that should give you a fairly good stab at being able to semi-retire, change employment type, or possibly not work altogether. Example I give is 600,000 typically would give you 25% tax-free. That's the amount you can draw from your pension tax-free. That's undoubted. 150,000 and provide an income of about 36,000 a year. And anyone who wants to know where that figure comes from, that's an 8% drawdown rate. And because your pension fund will grow post-retirement, and it should grow, as I've said earlier, even in a fund like Prisma 5 at 10 to 12% per year, that would certainly give you that return where your pension is not actually even going down in value, but you can still draw 36,000 a year. If you had a pension fund of 800,000, that would give you about 48,000 income with a lump sum of 200,000. For most of us, we could probably live reasonably comfortably, bearing in mind that we've paid off our mortgage. And if we haven't, we're going to use our tax-free sum to do so. And we can live partially off that tax-free money to supplement any further income requirements. And don't forget, guys, the state pension in Ireland that you're eligible if you have 10 national insurance years, or PRSI contributions, I should say, will give you entitlement. And if you have 40 full years, roughly about 14,000 a year, that gives you equivalent of about 250,000 towards your goal. If you work it out from 66 to a notional age of 82, multiplied by 14,000 a year, that's north of 200,000 euros. And for anyone who's listened to this before the 5th of April, you can apply for UK state pension buyback years. That's the national insurance years that I referred to. We have helped many, many individuals do this successfully over the last 2 years. And there is a deadline coming up. And if this does apply to anyone or anyone's partner or someone that you know, please do reach out to us and we can explain to you very easily how you
So
can
like,
qualify.
sorry, a question on pension. I have a 20-year DB pension with a previous employer. I'm 50. Generally, are you better to leave it there until 60 or take its transfer value, which is 350k, and invest it for the next 10 years?
It's a really good question. People think that defined benefit pensions, these promises that people are given, generally at 65 as opposed to 60, are the best things since sliced bread. However, that's not always the case. And that question, and thank you for asking, has given information around what the transfer value is. And that's the first thing we always say to people, find out what that is. We can help you do that. Then you work out notionally how much you could grow by and whether it's beneficial to you, because there are pros and cons of pretty much any decision that we make. The advantage of putting into the fund is that it can grow more than the promise that you're provided, but also that it doesn't die with you. A lot of defined benefit pensions die either fully or partially when you pass. Typically, in some cases, your spouse may receive 50% of that. Me personally, I wouldn't want to be in a defined benefit pension because I wouldn't want it to die with me. I'd like the asset to go to my next of kin. And for that reason, I would seriously consider looking at that, but it has to make sense financially. And again, in that instance, I would suggest that you should speak to a qualified financial advisor. And again, this is something that we do for individuals. These are some very quick illustrations about how you can retire early. And if anyone's not convinced, these are specifics. These are things that we've done for many, many individuals. But even someone in their mid-20s, if they were put in typically €1,000 a month, that their employer may be paying half of that for them into a pension scheme from the age of 25, they would have a pension fund worth north of 800,000 at 50. And that's in today's money. Someone in their mid 30s, again, who wants to retire at 55, who may have, say, a couple of old pension pots that they may not have any knowledge of or information on. And that's why it's really important to get advice. And definitely anybody that's been in a previous employer should be asking someone like Alpha Wealth to review previous pension arrangements to make sure that they're in the best accounts possible to give them that growth that I spoke about earlier. But in this instance, you know, if they put in roughly about 600 a month gross costing 360 with an employer matching contribution, they will reach that notional 800,000 by 55. And even for those people, let's say mid 40s, with a fairly reasonable pension fund. Now, again, it's really important to have it specific to you. And I've done a specific projection as an illustration. Now, I've used myself. I'm 51, but I've brought myself back to 35 to give some context to what may be suitable for most people on the court. Having a pension fund of, say, 100,000 and putting in a contribution of 600 a month shows me a fund of just north of 1.09 million. And that may sound significant to most people on the court, and it is. But the fact is, on the right-hand side, you can see the value in today's money, and that's the key number for us. So that's kind of like midway between the 6 and 800,000 that I mentioned. Now we're assuming a growth rate, which is the maximum we're allowed to of 6% per year, and that the contributions will increase at 3%. I don't know that these things will happen. I can estimate that they will, but annually, when I review these plans with our individuals, myself and David do this on an annual basis for our clients, it will get more and more accurate and you'll have a better, clearer idea about where you're going. And of course, you take account of things like bonuses, pay rises, if you lose a job, what changes there are. People often ask me about the best way to buy property. In my opinion, it's through a pension fund, which may apply to any pensions that you've built up from previous employments. Or if you're a business owner or a sole trader and you have a fairly reasonable sized pension fund, it is possible to buy a property. And some people like the idea of this, but there's a little bit of advice and there are pros and cons of doing so. And this is something that we can help you with. We've done it for many, many people. One of the other tax tips that I want to give you is about investing in tax efficient instruments where you get tax back from the government. There are only two ways that most people on this call can get tax back. One is pensions, and I would be a massive advocate of paying more into your pension scheme. But the second one is this employment investment incentive scheme. Anyone that's earning over 44,000 a year can pay 5,000, 10,000, whatever contribution amount they want into one of 50 or so qualifying companies and get roughly between 35 to 50% back on their investment and contribution. So, for example, if you put in 10,000 euros, you'll get at least 3,500 back from the Irish government, and you would have exposure to that Irish company looking for a gain as well as your money back. Now, obviously, some of you can probably guess this is not a risk-free investment. You are going to be exposed to the performance of that company. But a lot of these companies will trade well, and they have been trading successfully for a number of years. One of the examples is a renewable energy fund provided by a company called BVP, who have a fairly good track record over the last 15 years. And they put together a portfolio of 8 or 9 companies a year, and they give exposure to this at a minimum of 10,000. Now, this is something that becomes more prevalent in the third and fourth quarters each year. And as independent brokers, we come to clients with the best one or two options and show them why this might sit part of their portfolio rather than too much exposure to any individual share, or indeed having money in the S&P 500 where they don't get tax back. One of the final tax tips is about making sure that you're not building up too much wealth where you're going to leave your children a tax problem. Any parents on this call should know that they can only gift their children, or they can inherit up to 400,000 from two parents. Now, that may seem like a lot, but if you've got two kids and if you've got a property worth 5 to 600,000, most of their lifetime allowance is going to be taken up by that. And then if you've got a pension fund and other assets, it is almost certain that they're going to pay tax. Now, whilst it may seem like a first world problem, it can be easily mitigated by the fact that you can put money into accounts in their names, such as that child allowance we spoke about earlier, where it can grow in those types of investments that I mentioned, 5, 6% a year. And the taxman cannot touch any amount of that when it comes to any gift or inheritance. And that's a really good mechanism that I suggest people would look at. There are two others. I'm not going to get into them today with you. They're called Section 72, which is a life policy that mitigates that tax, and Section 73, which is in the savings plan. These are things that any parent that is in any way concerned about their child receiving more than 400,000 from them. And whilst I'm not trying to tell parents to give their money away to their kids, inevitably that's what is going to happen. And any parents out there who are thinking of using their tax-free lump sum of their pension to give them kids a gift to try and buy a property, that's really not a great idea. Let's say, for example, if you give a child 50,000 as a deposit to their first house, outside of the first 6,000 if you're in a couple, or 3,000 as an individual, the taxman's going to deduct that, in this case, either 44, 47,000 from that lifetime limit. And that 400,000, for most of you who are maybe not aware of this, is an index linked, so it's not going to go up each year, and was only changed last year for the first time in 11 years. It just shows you the government's apathy about the fact that children who receive a fairly decent amount from a parent, they're going to take tax off them. So just in terms of last takeaways, I mentioned earlier about mortgages. You should definitely consider an opportunity to reduce the cost of your mortgage. And as I said, we can help you independently. We do not provide mortgages in Alpha Wealth, but we give you first-in-class mortgage advice around how to navigate that. If you have a mortgage, you have mortgage protection. You can certainly not be paying more than 25 euros a month for in 99% of cases, and you can change it anytime. I certainly wouldn't want to pay more than 25 euros. And if that does apply to anybody, do reach out to us. Reviewing your existing arrangements in terms of health insurance, serious illness, and so on. Myself and David work with clients and help them in health insurance to speak independently, or indeed look at reducing the cost of these. As a business owner myself, I talk to business owners constantly about the best ways in which you can get money out of your business and make sure that your money's working for you. And then in terms of general insurance, things like car, home, and other insurances, making sure that you're not spending €1 more than you should be. And some of us, unfortunately, are time poor when it comes to these things, and we automatically renew. It's really not a great idea. One of the final things is this financial budgeter. This is a really important tool. It's available on our website. I encourage people to do this exercise before I meet them. I don't meet people unless they complete this. It only takes 5 minutes, but it's a really powerful tool in saying what income is coming into your household and where it's being spent. And then just having someone overview this, like in Alpha Wealth, to see where there's opportunities to reduce costs, increase returns, and make sure that you're finding the right balance between these short, medium, and long-term pots. Finally, just in summary, obviously I've spoken about FIRE, the elements to that, how to best get your savings working, not taking on unnecessary debt, how to navigate paying back debt, reducing your tax. I've given you 3 examples of how to do that, and then making sure that you repeat this with a financial planner at least once a year. And just finally, the cost of having a financial consultation with Alpha Wealth varies between €199 and €349. The difference in them is depending on how much you're earning and how much money you may be looking to invest. There's a little bit more tax planning that we do for the platinum consultation, but they are both very comprehensive, once-off fees that are never repeated. And David and myself go through a process of helping you with the heavy lifting of doing a financial summary and giving you recommendations as to where we feel you can make improvements on, helping you understand and doing that pension projection. But more importantly is that we do this on an ongoing basis at no further fees. If anyone has any questions, they can reach out to us on my email, info@alphawealth.ie. And of course, I'm more than happy to take any questions that anyone may have now.
Sorry, I was on mute. The first question is just around shares and where is the best place to sell shares?
Typically through the stockbroker that's holding the shares. So if you have a company shares, they may be held through the likes of Morgan Stanley or any of the other stockbrokers like Computershare. Generally, DeGiro, that was mentioned earlier, would be a fairly low-cost share platform. But again, if you want to reach out to me by email, I can give you some more specific guidance if you indicate kind of where these shares are being held currently.
At 64, coming up to retirement, should a person move fund to cash right now, move their pension fund to cash right now?
You should certainly consider moving probably 50% of your fund. I'm not sure would you necessarily want to move all of it. The reason being is that you're only going to be drawing typically 25% when you retire, and the remainder is going to go back into a fund typically. But certainly it would be worthwhile. And then in terms of the remainder, you can stay broadly invested as long as it's diversified. And on a scale of risk of 1 to 7, I'd probably be around the 4-ish level for the 50%.
And as a company owner, which is more efficient vehicle of investing for employees? Is it the employer-sponsored PRSA or Master Trust?
It's a good question. There are different types of pension accounts. Generally, the PRSA, as long as it's a low-cost PRSA, would be easier. It's more portable, and there's advantages both for the employer and the employee. But if you have what's called a master trust, this is the old kind of company pension as such, that can work equally as well. But again, if you wish to, just reach out to me and I can give you more specifics on that.
Just in terms of pensions, then there was a question that came in during the course of the presentation. It was pensions can't be self-managed, ? I thought there are options for those who want to decide what and where they want to invest.
They can be, and I have a small part of my pension in a self-managed fund, but that requires a little bit more work. It does also require more fees. And the thing you've got to ask yourself is, why are you in a self-managed fund? Now, unless you have a particular interest or appetite for it. But I've shown you funds such as the Global 5-Star 5 in Zurich that have annualized 12 to 15% per year with an expert manager managing your money. Unless you're convinced that you're going to better that, I'm not convinced that you necessarily should be in a self-managed fund. Where it might suit you is, for example, if you have, I suppose, a desire to buy a property. But again, that will only typically apply to a few people who have a fairly large amount in a fund, but it requires specific guidance. But for anyone who's looking to invest their own money, the Global 5-Star 5 Fund, and I'm not advocating all of your money to go into it, but that is the fund of up to 50 companies actively managed by Zurich. The information on the right hand of the screen is as of the 28th of February, which they've changed significantly. I can't better that. And I have an economics degree from the London School of Economics, and I've been an investment manager for 27 years. And respectfully, I don't know if anyone on this call can do so. If you're convinced that you can beat 15% a year, then fair play to you. But honestly, guys, it has been a very attractive environment in the last 2 years, particularly. We have suffered over the last month, and I'm a little bit weary about people thinking that they can continually beat the market.
I think that kind of brings us to one of the last questions, and I think you've answered it already. Every financial company will say they have the best fund managers in the country. Not a true statement. You can't say or prove that.
We use independent valuation tools to show you why we pick certain providers at different times. So respectfully, I can say that, and I can say that as an independent broker with no bias. I've shown you that I have an investment account with Zurich at the moment because of the fact that their fund managers over the last 5 years have vastly outperformed. They brought in a chief investment officer by the name of David Warren just before COVID, and he and his investment team, in my opinion, are the best performing manager, hence why you might see that we have a slight bias to Zurich. But having said that, you need to buy these accounts at the lowest fee possible. So anyone who has a Zurich pension or a Zurich investment, it doesn't quite end there. You need to go and see what fees you're paying. And if you're paying an allocation rate, i.e. an entry fee, or if you suffer exit penalties, or if you're paying a management fee of over 1% a year, then respectfully, you should come and talk to us, because that's more than you should be paying.
And just lastly, and we can wrap it up then. But overall, really, really good comments and lots of questions around kind of whether the recording will be shared, which I've said it will later this afternoon. But just to finally ask, what do you think of Prisma 3 from Zurich?
It's too conservative for most people on this call. If you've got a 3 to 5 year time frame, guys, Prisma 4 is a really good fund. 5 years plus Prisma 5, but it doesn't again end there. There are reasons why you might have some exposure to other assets like gold, but Prisma 3 is a really defensive fund. Now, if you are like that caller earlier who had a Zurich pension a year before retirement, then yes, maybe some of your exposure could go to Prisma 3. But the only people who are going to benefit from Prisma 3 are Zurich in their management fee and the broker who sold it to you. Typically, you're not really going to benefit over cash. So if that's an investment, if I were you, I'd get out of it and maybe put your money into the likes of a Raisin, guaranteeing you the 2.5% and not bothering with any management fees.
Anyway, Nick, I'll hand it over to you to wrap it up.
Thank you very much again, everyone, for your time. We are doing ongoing webinars, and we have done some. I did a webinar earlier this month in relation to the state of the market. One of the questions that didn't come up is now a good time to invest in the market? In my opinion, don't try and time the market. The best time to invest in the market is today. The key thing, though, is to understand that you've got to give your investment time. The longer you invest for, the more probability of success. So whatever people tell you about whether they think markets are going to fall or rise, the key thing is nobody knows. What you should recognize is that if you have monies available to you, make sure that it's managed correctly, preferably by a professional manager. But secondly, that you have got enough time to allow for any downside movement. As I said earlier, in Alpha Wealth, we're more than happy to give you advice without any obligation. It is a process that we feel very strongly about. David is an excellent financial planner, better than me at this stage. And I would strongly encourage anybody who is any way interested to make a financial consultation with us, and we can show you the various different streams to help you become financially successful. Thank you for your time today, guys. And we will be doing ongoing webinars, so do keep looking out for these. And I hope you enjoy the rest of the day. Take care. Thank you.